What's up, everyone? In this video, we're going to be taking a look at DraftKings' most recent earnings release. We have a lot of things to cover. I took notes on their press release. We're going to be looking at their 10Q. We're going to be taking a look at DraftKings on the stock analysis dashboard. We're going to look at their presentation and some other notes I took. So overall, we have a lot of things to cover. They grew at a tremendous pace this quarter. We have some important things to talk about. So stick around to the end. It's going to be important. So looking at DraftKings presentation, we'll start off by looking at their revenue. So quarter over, I guess you could say, in this quarter compared to their same quarter of last year, they had over $100 million in more revenue. So for example, in Q1 of this year, which is the most recent earnings release, they had a revenue of $417 million. In the same time period last year, they had $312 million in revenue. That's a 34% increase year over year. That's pretty dang good, so that's awesome. And they also increased their expected revenue for the full year. So let's check this out. Initially, in the beginning of the year, DraftKings was expected to have a revenue for 2022 between $1.85 billion and $2 billion. They are now changing that to have a revenue of $1.925 billion and $2.025 billion. That's awesome. If we look at DraftKings revenue over the past couple years, in 2017, they had $192 million in revenue. In 2021, they had $1.296 billion in revenue, and now they are expecting to have between 1.93 to like a little over $2 billion in revenue for 2022. That is amazing growth. Like in terms of growth rates, it's very comparable with some of these popular stocks like AMD, Tesla, and many others in terms of revenue growth rates. But overall, their revenue is growing at an amazing pace, but the stock price has been pretty bad lately. This is not DraftKings' fault. The market as a whole has struggled quite a bit. Even if we look at companies like Amazon, they are down around 40% from their highs, and it's like we're talking about Amazon here. Like even if we look at other stocks like Facebook or Netflix or anything else, a lot of stocks are down significantly right now. There are a couple reasons for this. I would say the first one is that stocks were just trading at a very aggressive valuation to begin with last year, like in 2021 and even in 2020. Some of the valuation multiples were ridiculous across many stocks. So not only did stocks have to make up for that, but we're also seeing stocks suffer from rising interest rates, which makes growth companies less attractive to invest in. On top of that, some investors are a little bit worried with DraftKings' lack of profitability for the time being. They are not profitable right now. Let's talk about their EBITDA really quickly. So while they increased their revenue guidance for the year, they also increased their EBITDA guidance. Basically, originally they were expecting an EBITDA loss of $825 million to $925 million. They since adjusted that to an expected EBITDA loss of $760 million to $840 million. So it's still a loss at the end of the day, but it's less of a loss. And I want to talk about how growth companies work really quickly. So, like we said, DraftKings is not profitable right now, but many growth companies looked the same ways in the beginning stages. We'll use Tesla as a prime example. Everyone loves Tesla now because of everything they're doing and how much they're growing, but back in 2016 and 2015 and 2014, there was nowhere near the same amount of love for Tesla compared to what we have today. And there are, of course, multiple reasons for this, but one of them being in terms of valuation metrics is that Tesla was not profitable in its beginning stages. It lost money for the most part all the time before 2020. 2020 was really their first profitable full year, and we could see everything before that was just straight losses in terms of net income. But then it ended up exploding up once they got their stuff together. They made their entire business more efficient, and they got their stuff together, and now they're finally profitable. And that's how many growth companies are. The goal with a lot of growth companies is you lose money in the beginning, and then with the goal of making a lot of money in the future. So that's what we're kind of seeing with DraftKings right now. Of course, not all growth companies end up becoming Teslas, but that's the goal. So we'll see what happens. But either way, they're losing money right now, which is not the end of the world, because there are countless other examples like this out in the market that ended up doing just fine, but we do need to see that net loss shrink over time, and we need DraftKings to get closer and closer to profitability. So that's one thing that we do have to keep in mind. If we look back at their press release and some of the things I highlighted, like we already talked about their revenue increasing and their guidance increasing, another interesting thing is that their MUPs were looking pretty good. Basically, DraftKings uses monthly unique players as a good measure of how their business is doing. Basically, it shows you, the number of unique paid users per month. In 2021, in the 3 months ended March 31st, there were 1.5 million MUPs, and for the same period this year, that's up to around 2 million. So that's some pretty great growth right there. On top of that, their revenue per MUP is also increasing. In 2021, it was around $61, and in 2022, it went all the way up to $67. So that's awesome. So that's good to see. They have more people on their platform every month, and those same people are spending more and more money. So that's great there. If we continue to scroll down, we can see that really this is just the beginning in terms of DraftKings, in terms of market share. For example, right now DraftKings has mobile sports betting in 17 states, and that only represents around 36% of the entire population of the United States, and they are still seeing tremendous revenue growth. So obviously there are a lot more states that are yet to legalize sports betting, but when they do, that can just make DraftKings grow even more than they are right now. On top of that, they do have the opportunity to operate in more states via a market access agreement or direct license. This is applicable to Maryland, Puerto Rico, and Ohio. If they do end up going with these opportunities, that will represent around 7% more of the U.S. population. So that's awesome. They're constantly expanding. On top of that, there is some new news kind of with California and sports betting. Basically, there was 1.6 million signatures submitted by Californians to, I guess you could say, solutions for homelessness and mental health. And maybe we're getting closer to legalized sports betting in California. We'll have to see. It's kind of a long shot, but we still have major states yet to legalize sports betting, like California, Texas, Florida, and a couple other ones. So there's definitely a lot of opportunity for growth in terms of just the sports betting market, but even for DraftKings' own market share. On top of that, DraftKings has also been improving a lot just on the features that they offer to their customers. Prime example of this would be their micro markets. Basically, DraftKings is going to have it where you can basically bet on anything you can possibly want. This is kind of a win-win for DraftKings customers and DraftKings as a business. If you're a bettor and you have the opportunity to bet on almost anything you want, obviously that's awesome, and at the same time, the more bets that people can place, the better for DraftKings, because they will win over the long term. So, in terms of growth, it's amazing. It appears that the main scare for now is still the profitability problem, but this is not anything new that we've seen. Like I said, there have been countless examples. I like to use Tesla as the prime one of, I guess you could say, companies where people freak out while they're not profitable, but once they get their stuff together, everyone loves them. For example, there was a ton of hate related to Tesla before they blew up, especially in 2014, 2015, and 2016. People were saying they were going to go out of business and all this stuff, but now that Tesla is profitable, everyone loves Tesla now. So, that's kind of how I see it with DraftKings. Of course, there are some crucial problems that DraftKings does need to solve. They do need to get closer and closer to becoming a profitable business. So we'll see what happens. As of right now, they have $1.77 billion in cash and cash equivalents. They have total assets of around $3.7 billion and total liabilities of around $2.36 billion. So overall, it's looking pretty good to me. Now, while you're investing in anything, whether it be stocks, real estate, businesses, or anything, it's very important to be objective. And you guys know me, I love DraftKings, but I still want to give an objective, I still want to look at it in an objective way. I love how they're growing. Obviously, their profitability is it is a concern, but what I don't like about DraftKings is how their shares have been increasing. We can see in this bottom right corner right here, the weighted shares outstanding have been increasing. This is not a good thing. Basically, the more shares of DraftKings there are out in the markets, it just dilutes current owners of the stock, and you don't want to see that. Now, it's not a good thing, but it's not a terrible thing as long as DraftKings can take the capital that they receive from selling shares and invest it or use it in a way that further grows the company that outweighs the dilution, if that makes sense. So, for example, like if DraftKings issuing new shares, or if the weighted shares outstanding is increasing, as long as they can make it worth diluting, then it's okay. But if they can't, then there's a problem. If we look at companies like Amazon, even they've been issuing shares, which they're not issuing shares to the extent that DraftKings is, but ideally, when you're looking at any company, you want their shares outstanding chart to look like Apple. You want to see it consistently falling, because this means not only do you benefit more from the company growing, but you also own more and more of that company every month, because the company buys back shares and basically burns them, and it gives you more ownership of the company. So keep that in mind. But all in all, I thought their earnings report was pretty good. They're growing at an amazing pace, and they're increasing their expected revenue, which is awesome. They raised their EBITDA, which is great. Their monthly unique players is rising. It's really only the beginning. They only have mobile sports betting live in 17 states, which represents around 36% of the U.S. population. They have $1.7 billion in cash. Oh, one other thing I did want to mention while looking at my notes is that implied volatility is very high right now with DraftKings stock. You guys know me. I love DraftKings. I own shares of DraftKings. I love to sell puts on DraftKings. Even though the stock's been getting destroyed lately, I plan on holding for the long term. And yeah, I plan on holding for the long term. If you are playing DraftKings, do not try and time the bottom. And you can say the same thing for any other stock or any other market. Stocks are crazy right now. There's a lot of volatility out in the markets. So if you did want to play DraftKings or really any other stock right now, you probably want to do it for the long term. If you're looking at options for DraftKings, implied volatility is very high, so it would be ideal if you played shares or you shorted options to take advantage of the high levels of implied volatility. So like short put options, not short-term put options, but like sell to open put options would be ideal, or just good old shares. That's just my opinion. Of course, do your own research. I love DraftKings. I don't plan on selling them anytime soon. Their growth is very respectable over time. As long as they can get their profitability together, I think they're going to be quite the powerhouse. But time will tell. Thank you guys so much for watching today's video. Make sure to check out that first link in the description and the comments down below. We have a brand new tool. It is awesome, especially for this market environment. You can type in any stock and see if that stock's actually worth buying or not. It's an amazing tool. You get access to all the fundamental data you can need. You can compare the stock using our TA dashboard. We have our calculator where you can calculate your own price targets. It's awesome. Check out the link down below and have a great weekend.